All right, let's talk about investment crowdfunding. It's this incredible idea, right, that anyone, and I mean anyone, can invest in the next big thing. But what if I told you there's a huge hidden flaw in this system that's leaving thousands of people like you completely in the dark?
So picture this. You find a startup you really believe in. You love their mission, their product, everything. You put in a few $100s. You're an investor. You're part of the story. And then crickets. Just total radio silence. No updates, no news, nothing. You've just been ghosted.
And this isn't just you getting snubbed at a party. This has a name: investor ghosting. It's when a company raises all this money from the public, from you, and then just vanishes. They completely fail to provide the annual updates they're legally, yes, legally, required to give. This isn't just rude, it's actually against the rules.
To really get why this is such a big deal, we gotta rewind to 2012. Congress passes something called the Jobs Act, and it was a total game changer. For the first time ever, it meant that regular folks, not just the super rich, could get in on the ground floor of a startup. The goal was amazing: to democratize investing. But of course, there was a catch, a really important one. To protect all these new, everyday investors, the law included a crucial safeguard. Any company that raises money this way has to file a public annual report with the SEC. It's the most basic rule of accountability. You take our money, you tell us what you're doing with it. Simple.
So the big question is, are they actually doing it? Is this super important fundamental protection even working?
Well, get ready for this because the answer is pretty shocking. Turns out most companies just aren't. Yeah. The data shows that the vast majority of these crowdfunded companies are flat out ignoring the rule. They take the cash and then, poof, they're gone. Okay, so why? What's going on here? Well, it could be a few things. Maybe it's an honest mistake. Founders are busy. They just forget. Or maybe the business failed, and they just don't know how to break the bad news. And yeah, sometimes it's probably deliberate. They're just trying to avoid scrutiny. But you know what? It doesn't matter why. For you, the investor, the result is exactly the same. Your money is gone, and you have zero clue what happened.
And this isn't just a small problem. This widespread failure to report has a real systemic cost. It's actually threatening the entire experiment of democratized investing.
And that right there, that gets to the heart of it. This isn't just about a few investors losing some cash. When companies can just go dark without consequences, it chips away at the very foundation of the whole system, which is trust.
Let's break it down. When you make an investment, you have expectations, right? You expect updates, you expect accountability, and you hope for a financial return. But when a company ghosts you, well, your investment basically turns into a donation. It's a gift. You've given away your money with no real expectation of ever seeing it again or even finding out what happened to it.
So you're probably asking, if this is illegal, why isn't anyone stopping it? And the simple, brutal answer is that the enforcement system we have right now, it's completely broken.
The SEC, the Securities and Exchange Commission, is supposed to be the watchdog here. But let's be realistic. They have a massive mission and pretty limited resources. Are they really going to chase down thousands of tiny startups from missing a filing? It's just not practical. It's like trying to catch every single raindrop in a storm.
And this is what's so dangerous. It creates this vicious cycle. If investors keep putting money in and getting nothing but silence, they're just going to stop. Trust will completely disappear. And this whole incredible idea of crowdfunding could literally collapse under the weight of all that mistrust.
Okay, but it is not all doom and gloom, because the same expert who uncovered this mess also came up with a fix. And it's so simple, it's brilliant.
See, what we need is something cheap, easy, and most importantly, something that doesn't require a whole new act of Congress, because we all know how long that takes. So, does a solution like that even exist? Yes. And it all boils down to this one single powerful number: 1%. The idea is just genius in its simplicity. When a startup successfully raises its money, the crowdfunding platform just holds back a tiny piece, just 1% of the funds. The startup gets that last little bit of cash only after they filed that first legally required annual report. It's a small amount of money,
but it creates a huge incentive to do the right thing.
Now, if this idea of holding money back sounds familiar, it should. We do this all the time. It's called escrow. Think about buying a house. The money goes to a neutral third party, and the seller doesn't get it until they've met all their obligations, like making repairs. It's a standard practice.
So we can apply that exact same logic here. The platform acts as that neutral party. It holds on to that 1% until the startup fulfills its legal duty. No report, no final payment. It's just a simple, automatic nudge to follow the rules.
And here's the best part. The SEC can do this right now. They already have the authority. This doesn't need a new law or some big political battle. All it takes is a simple rule update. In fact, the professor who came up with this has already drafted the language for them. It's ready to go.
So why are we getting so worked up about this one little fix? Well, because it's not little. It's about restoring trust in the entire idea of crowdfunding.
We can't forget that the original goal here is still so powerful. It's about leveling the playing field. It's about letting anyone, you, me, our neighbors, back the ideas and the people we believe in. It's about giving more entrepreneurs a shot at their dream.
But that beautiful promise means nothing if that open door just leads to a dark, silent room. Trust really is the currency of this market, and every time a company ghosts its investors, it debases that currency a little more. And that brings us to the final thought here. If we don't make a simple change, like this 1% solution, investors are going to keep getting ghosted. And eventually, they're just going to ghost the market right back. They'll walk away, and this incredible engine for innovation could just fizzle out.